Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world. Happy Flag Day week, everyone. Flag Day was in here this week someday, I think. Not sure when, but we've got some banner guests coming up on the pod. See what I did there? Headlined by Nancy Davis. We talk a bit about tips on this pod, and I literally know next to nothing about them, so excited to hear Nancy do her stuff and join us on the show. On to this episode, which was as much fun as I've had with a Frenchman since, well, that's a story for another time. We're talking with StoneX's global macro strategist, Vincent Deluard, covering inflation, deflation, stagflation, greenflation. I should have brought up shrinkflation and hit for the cycle. We get into the Swiss milkshake, JGBs, global demographics, why nothing gets done in 2022, and recorded right after the Fed hiked 75 bips, which was a bit of fun to hear his first thoughts live. It's a good one. Send it. This episode is brought to you by RCM's China Group. We talk a bit about China in this pod. And you know who's been on the ground in China for years figuring out their derivatives markets? RCM's China Group, which has Chinese investors looking for and funding Western trading talent. To learn more, visit rcmalts.com/China. And now, back to the show. All right, so we're here with Vincent Deluard. Did I pronounce that correctly?
You pronounced it well enough. I've been here for 15 years, so I've heard a lot worse.
Well enough. And where you're French originally?
Yes, I'm French. I'm from Burgundy, and then
Burgundy.
The U.S. about 16 years ago.
All right. Are you a big Tour de France fan?
I was when I was a kid. I mean, I had, the whole doping stuff. I mean, it's been a bad few years, but when I was a kid and I did not perceive any of that, I just saw the guys on the bikes and the landscape. I mean, it is one of the greatest races in the world.
Would you go watch in person?
Yeah, I would go. I mean, it didn't go through my hometown a lot because it's not really in the mountains. So I would go in the Alps or the Pyrenees, like the big calls, like, when they have to like climb up. I mean, it's very, very spectacular. And I like the atmosphere as well. It's a very popular feast.
Yeah, I've become addicted somehow here in America. So I spend coming up here in July. I'll spend most of my July watching hours and hours of the television till 2 a.m. Right. And I just record it and fast forward through it and catch the scenery. So it's on my bucket list to go actually check out a race or two.
I think you should, and, make a trip out of it. It's an experience, being on the spot.
And speaking of Burgundy, so there's some nice wines from there, right?
I heard so, yeah.
That's the rumor. And then I think you have a little bit of experience with doing some stuff in wines. What's your wine link backstory?
Well, really, my main qualification for this is that I look pretty French and I talk pretty French, especially 20 years ago. When I happened to be in China, I was doing the English teaching gig back then. That was a big thing. It was just opening up. And then because of the way I sound, I was approached by someone who was supposedly selling French wine to hotels and restaurants. Now, I only suspect that it was not real. I cannot prove that. But I think I was hired mostly to look French and go to dinners in weird second-tier cities in China. That's about 20 years ago. That was just after the SARS pandemic. So at the time, like, this was a really different country. And my job was mostly to get a glass of wine, look at it in the sky, make some absolutely absurd comment like, oh, it tastes of mushroom and butterflies and, coconut and pineapple, and then taste it in the most noisily way possible. And then all the guests would do at the time, this wine was just starting in China. So just gambe and just drink the whole thing in one shot.
Wow.
So that was a very...
So, but you must have tasted it. So did it taste legit or not so much?
Well, after a few glasses, it tasted great.
So maybe it just had been somewhere around France.
Yeah, I would think it was actually probably Moldova based on the people that I've seen around. Like, it's a small country in Eastern Europe, which is probably next on Putin's list. But they do produce wine. I think it's probably the cheapest place you can buy grapes and then put them in a bottle with a French label on it, which I suspect was going on.
And then, did you speak Mandarin? Did you speak Chinese at the time?
Very, very poorly, but it was a great source of amusement for my guests.
Yeah. They were like, say something about wine in Mandarin. Awesome. And so then you made it from there back to France or straight to US?
Yeah, eventually, back to France. And then I was fortunate enough, my school had a dual degree with Columbia University. So I got into that. That brought me to the US in 06 or 07. This was, pre-08. So if you could open up an Excel spreadsheet, you could call yourself a hedge fund analyst, which I could do. And then, I've been doing research ever since. And it's, funny how the ways that life takes.
Right. And so now where are you located? You're out in California?
Yeah, Oakland.
Oakland. All right. So you're rooting for the Warriors? Is that game tonight? When's the last game?
Game
6.
I am more interested in the Tour de France than the Warriors.
Than NBA basketball. Okay.
Yes.
So we happen to be recording right here at 1 p.m. Central, which is right about exactly when the Fed just announced. So let's do a little live Fed report takedown, if you don't mind, for a quick second. What did they do? They were talking 50.
I hear they cut by 50, surprising the market.
Cut by 50.
No, so I think 75 basis points. That's pretty much priced in with uncertainty. And rates at 3.8. I think that's a little higher than people expected.
And what's that again? Say 3.8 is there what?
3.8 for the terminal rate is what I see on the Bloomberg. Seems to be high. Well, I mean, for me, it's pretty low, but I think compared to where the market was, it may be pretty high. Let's see how the market reacted. 10 years up, 2-year was down and then shot up. It looks like it's stabilizing. It looks like, not too much drama, which is probably what they were aiming for at this point. Just, no news is good news.
Yeah. Some people are calling for just do 150 and get it over with. What's your thoughts on the whole get it over with phenomenon?
Well, I mean, I get the idea. I think the logic behind it is, if you have very few cartridges in your gun, right, you might as well just shoot them all at once at the beginning to make a big impression. I think that's the idea. Now, of course, the problem is that after that, what do you do? I think that the fundamental problem is the Fed is, they can, they missed it. They missed it. That there's no other way to say it. I mean, and I'm not talking about like the pandemic stuff. That was fine. Buying high yield bond, whatever. You had to do what you had to do back then. But, up until last month, for God's sake, they were buying mortgage-backed securities with the kind of inflation we had, the transitory stuff. So, they missed it by about 12 months now, and they have to make it back. And there's probably only so much they can hike without seriously breaking things. I think we are in the process where they start to break things. There's probably only a couple rate hikes they have left. Why not? Maybe front load everything. Try to shock the market into submission, try to restore inflation expectations. Probably is the best strategy. I don't think it's going to work at the end of the day. I don't think anything that they can do will work. I think inflation is secular, it's structural, it's mostly a supply shock. But probably front loading is the logical reaction to having been so late for so long.
But they didn't do it. So we'll see what happens. So speaking of those inflation thoughts, so you were kind of early on your inflation call versus other economists. Would you call yourself an economist or just a researcher? I don't know if that's a bad word for you, economist.
Yeah, I would prefer researcher. I mean, economist doesn't have a definition, right? Anybody can be an economist. It's probably the only science and I use science with air quotes. I don't know if it's recorded where really anyone can just show up and make a forecast and call themselves an economist. So no, I didn't have the audacity to call myself an economist. What I did, and I like that you said that I was early. Another word for early in my case would have been wrong, because I was so early that, so I actually started worrying about it. My first report on inflation was, I don't know if you remember, Bloomberg Business Week in the summer of 2019 had a cover called The Death of Inflation. There was a little dinosaur, inflated dinosaur on the cover, which I thought, oh my God, this is the echo of The Death of Equities that they published, I think, in 1979.
The famous magazine indicator. Boom.
Correct, right? So I went through this whole spiel of like reports saying, no, it's different. Inflation is not dead. We have all these cases, demographic, technological, for secular inflation. And that was even pre-COVID, right? And I remember my 2020 outlook was called only one forecast, reflation. And then boom, COVID hits, everything shuts down. Oil prices go negative, 10-year yields goes to 50 bips, inflation expectation goes super negative. And in April 2020, I remember looking at this and thinking, this is crazy. Like, we are constraining supply like crazy. There's no way we can keep everybody locked down without giving them money. So we're going to have to like push a lot of money. This is going to accelerate so many things, MMT, the digital transformation, work from home. This is going to be the biggest inflationary shock in a generation. So I published a report in April 2020 called A Crazy But Logical Call for Stagflation. And I still think to this day, this is probably the best report, best title I've ever done. And of course, as time passed, we had, inflation slowly accelerated, reached 2%, then went a little bit over it. It was called transitory back then. Then it fell a little bit in 2021, which seemed to validate the, 5 Ds of deflation, demographic, debt, all of that stuff, disruption. But then it came back. And I think at this point, I don't have the burden of the proof. Like, I think that the people who argue for deflation or even disinflation are the ones who need to explain. I think that the base case should be that, it's going to be stagflation and it's going to last, I think, longer than people think. I still think the transitory narrative is not dead. It's still in the market. They just kind of extended the definition of what transitory means in terms of magnitude and length, but we still have this framework that it cannot happen here.
Yeah, I think you see that with stock market prices in particular, right? Of like, the market's down 20%, inflation's going to be dead. Like, this is going to snap back so far, inflation's going to fall off a cliff. I'm like, I'm not sure you quite understand what it means. And at the same time, I'm paying $6.49 a gallon here in Chicago for gas. So
like, that's cheap, man. I'm at $7 here.
I know. At Costco, when Costco goes over $6 here in Chicago, that's going to open some eyes. And interested in your take. So secular inflation versus stagflation. Just give us a little definitions there of how those different.
Right. So by secular inflation, I mean, I think the inflation cycle is probably one of the longest. You have your commodity cycles are quite short, equity cycle around 10 years, and then bond inflation move very, very slowly, right? So basically you can think of, there are 4-year cycle really of disinflation since, the Volcker Fed, so 1981, all the way down to 2021. This is what I meant, secular disinflation. I think we have something like that the other way, kind of like the prior 40 years with, between World War II, the Korean War, the Vietnamese War, you had like secular rising inflation. I think that's where we are because of demography, because of really mostly, I would say, demography, but also geopolitics, even technology. We can talk about this as well. So that's like the 4-year picture. And then you combine that. So that's
4 or 40.
40, I would think of. Like rising. I mean, in the sense that inflation will be a problem for a very long time, like the same way that certainly outside of the US, unemployment was the problem for, pretty much since the end of the oil shocks, really in Europe since, 1971. The biggest problem was not enough demand, unemployment rate. That was a problem for most of the world. The US was a little bit better, but, that was a reflect of the deflationary mindset. We move to a world where unemployment is no longer a problem, inflation becomes the problem, and it will stay there. Now, of course, it won't be a straight line. It won't be at 8.5% all the time. There will be ebbs and flows, but in general, I don't think we'll see sustained period where we don't have to worry about inflation the way it was, in the 90s, in the 2010s. That era is behind us. So that's the deflation part. Now, as far as the stack goes, I'm actually relatively bullish on the economy compared to consensus, which consensus is so bearish that,
not hard.
Stag is bullish, right? Because everybody expects a recession, right? But obviously we are coming at the economy will have to slow because of the amount of tightening we're doing, because of the strength of the dollar, because also of the difference in the fiscal impulse, right? We had so much stimulus that, just removing that is going to slow the economy. So in the short term, stagflation is logical. Now, over time, I would think it could actually be a high growth period. You look at the 70s, I mean, it was not that bad. I mean, we had 2 recessions in the middle, but overall, I think real GDP growth in the 70s was much higher than it is now. So it doesn't have to be, I think we're just entering a new era of, the main difference is going to be inflation and then distribution versus concentration of wealth.
And so some of this is tying in with your thread I read a little while back on saying nothing works in 2022. And so some of these underlying themes there, so talk a little bit about what some of those underlying themes are there that you're seeing that can persist. Yeah.
So basically, going back on inflation, I think that the main driver is demography. And this is something that people get mixed up all the time. We have the Japan, I hate that word, whatever. Like, sample of one. Okay, aging is deflationary. Why? Because Japan. Well, I mean, my view is that aging is maybe it's deflationary at first when you have a lot of high income empty nesters that can save. When your boomers are 50 to 60 is deflationary, but when your boomers become 65 to 75, it becomes massively inflationary because you have a lot more net consumers and you have fewer workers. And I think that's the problem we have in the US, all around the world. It's even worse in East Asia. It's catastrophic in Europe. So you have this kind of squeeze on labor. Too few people work, too many people in retirement or disabled, too few people working. And then at the same time, you have a squeeze on capital as we remove the central bank liquidity. So if you think of your production function as a function of capital and labor, both things gets squeezed. The only thing that can save you is productivity, which, in standard economics is a residual you don't explain. So if you want to make a case for deflation, you have to make the case that productivity is going to spike. And indeed, I've seen a lot of that. And people like to make fun of Cathie Woods and all that, but I do think she has the most interesting argument for deflation. If you want to make a case that prices are not going to go up, you have to go, all over the exponential age and argue that, COVID is a positive productivity shock. So that's where I disagreed in that thread you mentioned. I think that's a joke. Like, I mean, you just go outside your window. Like, COVID is not a productivity positive event. I mean, we are, making, people take their temperature and stick stuff up their nose and restricting travel and creating a whole class of consultant in COVID protocol, closing the Chinese economy, creating, stop and go patterns. Nothing works in 2022, and you can see that. I was in France in the past 2 weeks, I mean, waiters even worse than usual. Hotels are booked.
That's saying something for a French waiter, right? Are they notoriously bad?
Yes, but it's not just that. It's just, you don't have enough people to work. The people who are working are burned out. The level of anger, rage, you can feel it everywhere in the US, of course, with the political stuff, but even in Europe. And all that, to me, makes the economy kind of stickier and does not work as well. Like, I mean, I think we look back to 2019 as some sort of a golden age, even though it didn't feel like that back then.
Right now, people seem to miss that connection right there. Same thing. You're out there, you're with friends, and they're complaining like, "Oh, well, they can't get help. That's why the food is taking so long." And these are first world problems, to be sure, but right. Or like, we can't get a car. I ordered a refrigerator. It took all this time to get there. But then they're like, and why is gas so high? So they seem to be disconnected in people's minds. And you're saying even in economists and other researchers' minds and papers. And so back to Japan, because you hate that word, I want to hammer on it. Why was that different? Why is their demographics deflationary for them, like famously so or infamously so?
Right. So first of all, I think that the magnitude of the bubble in Japan was just something else, right? I mean, you remember in 89, supposedly the Imperial Palace was worth more than all the real estate in California. So
yeah,
what you had to observe, right? I mean, the MSC, Japan was like half of the world's market cap. And it's a tiny island with, I mean, yeah, now I feel the US is overvalued, but at least it's the US, right? Japan. So it was much bigger bubble to start with. So you had to deflate that for longer. Then the other thing that was specific about Japan is it's next to China and South Korea and all of Asia. And in the 90s, what happened is the biggest macroeconomic shock in the world, the great doubling, right? Suddenly you had, basically the Asian continent was kind of shut off the global supply chain, shut off the global economy by communism comes in with massively undervalued currencies in the case of China. And then throughout East Asia after the East financial crisis, right? The Thai baht, the Korean won, everybody comes in with like depreciate the currency by 80%, has these very young, productive workforces that come into it's a huge deflationary shock. And Japan was really like literally on the edge of that. And a lot of the manufacturing capacity moved overseas. So this is where the deflationary shock came in. You had to work off that bubble, and then you had to the impact of the entry of China into WTO, and then you have all the cultural peculiarities about Japan. It's a massive net saving country. The corporate sector wants to save. The household sector wants to save. All of that is very, very different from the US. Massive creditor country. So I think we are trying to extrapolate from a sample of one. And in general, I'm not an economist, but I've heard something about, sample size.
right. But it feels that's the global case now, right? So that they may have been just the poster child of like cheaper labor and globalization. And now if we're moving away from those two themes, they moved away from it 30 years ago. And now maybe we're seeing that in the rest of the world today. Two other items I liked in that conclusions of that, where there's no Fed put. So talk a little bit about that. They're out of bullets. What's your theory on there's no Fed put anymore?
Yeah, I actually think of it more as a Fed call, a Fed short call. I think the market is obsessed about like the Fed put because this is what we've been bred with, right? I mean, ever since LTCM, every time the market, drops enough, throws a big enough tantrum, Fed comes in and saves the day. So, now we're down 20%. I mean, I see all these parallel to 2018, right? Oh, look, Powell back then, he was also talking a big game, but eventually, we can will the Fed into submission, right? The repo market freeze is what did it last time. Maybe here I don't know what's going to do it, the NASDAQ blowing up or crypto, I don't know. But there's still this hope that the Fed will come and save the day. I'm not sure because at this point, inflation is a political problem and the Fed is a political entity at the end of the day. Inflation is more painful at this point than the closing price of the NASDAQ. I mean, the closing price of the NASDAQ is very relevant to people like us, but for most people, that's just a number out there. I mean, it really doesn't register even. What matters is the price of gas. This is what's going to make or break election. And elections are what's going to make or break the Fed. And the Fed has been late on this. So they have to double down by, being extra cautious to make up for the mistake they made in the past. So I really don't think there is a Fed. And you still see that in the Eurodollar curve. I mean, if you see there's this kind of like March 2023, there's expectation that the Fed's going to stop cutting. I think this is kind of crazy talk at this point. What I would think, though, is that we have a short call. And by that, I mean that if and when the market does stabilize or even go back up, then you can know that the Fed will just go back in and just like squeeze in another 75 basis points. So that's the more likely outcome. If things do get better, I think that the Fed will be very happy to jump in and throw in more tightening. But I'm not sure that they have the capacity to cut or do anything to ease things if markets get worse and throw a tantrum.
I thought you were going to go with there's not a long Fed put on equities. There's a short Fed call on energies, right?
Yeah, that too. Yeah.
I like that. Because really, like you said, that's the thing people care about.
Yes.
What? And as you mentioned, what are your thoughts on? I agree with you. Even in our space, I feel like people aren't talking about the NASDAQ bloodbath enough, right? You look at those list of ARK stocks down 60 to 90%. Like, it feels if you look through some of those names, like 2000, the .com bust, but not nearly as much press, not nearly as much pain. So I don't know what I put that to. What do you think is the reason for that? Just there wasn't enough. Those were all speculative bets to begin with.
Yeah. Also, I mean, I feel the bubble was so much bigger, right? That so I mean, still, even if you look at the market as a whole, I mean, we're still up quite a bit from 2 years ago. I mean, if you'd fallen asleep in whatever 2018, you just wake up, you open your brokerage statement. Oh, I had a pretty good 5 years. So I think there's maybe more tolerance for that, and also I feel we are just starting to see the stuff that hurts, which is layoffs, basically, tech companies. But so far, it's been the small stuff like the Binance and the crypto stuff, announcing like 20% layoffs. But I think when you start seeing like maybe Apple or Microsoft and Google starting, announcing like maybe even Amazon, like mass layoffs that could, potentially affect, hundreds of thousands of people. And keep in mind, and they can, by the way, I mean, there's just so many product managers at Facebook. Like, what do they do? What's a product manager? Like, I feel that's the next thing that's going to happen. It's just going to be like, all this massive hiring that happened in tech, push wages like crazy in the Valley. This is going to bleed out. And then maybe it's going to feel more real. At this point, it's still a little theoretical, I think.
What's your marker for when that starts to happen? Like Bay Area real estate starts to tick down?
Yeah, I would think.
Just literally like Microsoft announces 8% of the workforce is getting laid off.
Yeah, I think that. I mean, on the real estate, I think the issue we're gonna have is so much of the bubble was due to stock-based comp, right? I mean, if you are and that greatly bothers me, by the way, because friends of mine who graduated at the same time as me and went into tech, and I used to make more money than them when I started, and now these guys are like destroying me because they're getting 50% of their comp in stocks, and stock of Google just been straight up. So I mean, most people like late 30s, they're multimillionaires just by having a job, not even like starting as, having a job. So my point is really, that was the fuel. That was the kryptonite of the everything bull market in the Bay Area was stock-based comp. And it was great for companies because it cost them nothing, right? They can print, they can't print dollars, but they can print their stock.
Where it was on the back of the pensions and the institutions buying up the stock.
It was perfect. You had this demand also from index funds and, so it was fantastic. And then, if you can outsource, because for big tech, your only expense really is labor, right? I mean, a couple servers, but that's it, right? So if you can outsource 50% of your payroll to the stock market, your free cash flow, we're a free cash flow machine. Of course you have great free cash flow because you pay your employee in stock. So I think that's going to be the process as the value of these stock rents is revised down. People who think they were making $500,000 a year realize that no, they're just making 250, still quite comfortable, but the Bay Area is an expensive place to live, and then that's how it feeds into the real estate market.
It was almost the perfect perpetual machine, right? Then they'd get that income, put it back into index funds that would put it back into Apple.
We invented the perpetual motion machine. We did.
I saw some good Twitter action the other day of it's like maybe paying a software engineer $400,000 a year for a free app wasn't a great idea. Like maybe that's the cash flow problem.
Yeah, and I would argue that fits into the inflation problem also, in the sense that, I call it the millennial lifestyle subsidy, right? Oh, your Uber, it costs like, $10 to cross the city, or, you can pay some poor guy to cross the city on a bike under the rain to bring you a sandwich for $2, or the stupid little scooters. All of that was loss making, and all of that, the idea was the whole unit economics, right? I'm selling $1 for 95 cents and I'm making it up on volume, which of course never made sense. But the point is, we've done that for 10 years and that effectively kept the lead on prices. Like, real cabs have to compete to Uber. So if Uber subsidize, drivers, then they have to drop the price. Hotels have to compete with Airbnb. So there was that hidden subsidy in the market from this kind of insanity. And I think it's being removed now. So the first step, I think, as we remove the punch bowl is actually going to be inflationary, because you have to remove all this uneconomical production that we have subsidized for a decade.
And I've heard it argued, right, that subsidy was on the back of that guy who's biking the sandwich across, right? He's using his bike, he's using his time.
Right.
And what's he really making on that? Or on the Uber drivers, I've been a lot of studies that, right, that's not such a great career and you're really making way less than you think.
Yeah, no, it's funny. I spent some time in poor developing countries, say that, and it strikes me that when I come back to like Silicon Valley, I'm like, wow, these guys have reinvented the coolie. It's like so much of the innovation and the productivity enhancing stuff. I mean, you go to Kolkata or Bangalore, or actually Bangalore is quite wealthy, or Lagos. Yeah, there, you have a guy who, fixes you a sandwich, and you have a guy who drives your kid to school, and you have another guy who's, who cleans your pool. I mean, in a way, we've kind of reinvented this gray economy of, massively underpaid people serving wealthy people. We just put an app in between and call that productivity enhancing.
And what that was one of your themes, right? That wealth concentration is going to turn back to wealth distribution.
Yeah, I would think so. I mean, personally, it would not necessarily be in my interest, but I think from a social political perspective, I mean, we really stretched this, so far. I mean, if you look at the ratio of, for example, the minimum wage to the S&P 500 index, I mean, you look at that over the past 40 years, like, well, this cannot possibly last. I think we start to have like consequences like populism, riots that really threaten social fabric. And I think we're getting there before COVID, and COVID kind of sped up that increase. As with many things, it was unraveling under the surface. COVID just made it obvious.
And then does all this Fed and inflation thwart that though, right? Of like, hey, the workers started making more money, it causes all this inflation, the Fed hammers it down. Right. Or they've reached a new minimum level and they're not going to come back off that.
But I think at least, so far the wages are growing faster at the bottom, which I think is very, very positive, right? I mean, it's growing faster for uneducated, it's for non-white, for hourly workers, for young workers. So that wage gap that used to be always in the favor of, those who are doing well has inverted, because the squeeze is on low qualified labor at this point. So I think nominal wages, they're not keeping up with inflation, but almost. And then what's really happening with the Fed hikes, the value of assets being written down. And that's what you need, right? If you think about inequalities, inequality is really about, is really about who owns what. So if you write down the value of assets, that means that access to property, buying stocks is a lot easier than it used to be. In the 70s, you all hear these stories, right? You take a summer job to pay for college, or, pay back your mortgage in 3 years. But this is the stuff that's required to kind of rebuild a thriving middle class. And I think in order to do that, you need to write down the value of assets. And it's painful for us as asset owners, but that's what we're witnessing right now.
I have my doubts that that's going to happen anytime soon. Anecdotal, but we were at a lake up in Wisconsin, and the realtor guy's telling us, like, it's nice. Like, he's like, for $1 million houses, I have a list of 120 people who are like, there's nothing for sale on the lake.
Right.
As soon as one comes, give me a call. For 5 million and up, he has a list of 40 people, and he has a list of 20 people who says, call me no matter the price.
Yeah.
So, right. So I feel like there's so much money waiting to pounce and buy up values that I don't know if we'll ever get there, unless it's massively painful.
100% agree with you. And that's why it's going to be a very long and slow process. And I think that's why the market is wrong, thinking it's going to be over so quickly, because basically we're trying to address inflation with the wealth effect. And the wealth effect is a very crappy tool when it comes to controlling the price level. And we saw that on the way up, right? I mean, when Bernanke started with QE and started talking about the wealth effect, I mean, it didn't work for 10 years. For 10 years, the Fed was like pumping asset prices, and then in fact, prices did not respond. But I think the same way now that they're trying to take the liquidity out, hoping that asset prices will fall, and then that will eventually trigger to the CPI. That's a multi-year process. I mean, the market is expecting this to be over in 3 months. It's not over, especially given how, as you point out, huge the bubble is and how much liquidity there still is in the system.
So speaking of that, let's talk a little bit of what someone would use for an inflation hedge. We're not just here to talk about this, right? Like people thought crypto was going to be famously a bad call, but people thought crypto would do it. People thought tips would do it. I'm going to have Nancy Davis on, I think, next week talking everything tips. But my guess is people have been super disappointed with tips performance. Even though you could argue, no, as expected, the bond piece went down. Trend has worked. Energy companies have worked. Commodities have worked. Gold hasn't worked. So what are your thoughts on what inflation hedges are out there and why they perform the way they have?
Well, yeah, I'm going to rebound on tips because I think that is probably one of the most underappreciated signal in the past month or so. Is tips yield have flipped positive, because of that duration effect, right? But like on the 10-year tips, you're getting 70 basis point positive real yield for the first time since COVID. I think that is important. And yeah, I was bearish on. I didn't think tips were a good hedge because of that duration component, but I think now that you can get them at a positive real yield, it's probably the first time in the cycle that I think they have a place in the portfolio. Gold, I've liked the gold and precious metals. Silver is disappointing me more than anything in the world.
That's quite a statement.
Yeah. I've been wrong on that. Although, gold is, the thing is, gold is not a perfect anything, right? That's both the beauty and the downfall of gold, right? People tell you gold is a hedge against political chaos. It's a hedge against inflation. It's a bet on emergency. It is all these things and none of them at the same time. So, I still think over the long term, gold is there. Gold had a big rally in 2019, 2020, taking a breather there. When you have days like what we had last week, everything's going to sell off at the same time, including the things that should not sell off, like gold. But I would still think eventually you're going to make it back up on precious metals. Just I think it's a matter of like setting the right expectation. And in that sense, like I feel a crypto bubble has really polluted our minds. Like, I hear people like, I need to double my money in the next 3 months. What should I do? I don't know, go to Vegas, if you look at, 3-4 year, gold has had very good returns, especially in non-dollar term. Gold is at an all-time high in euro, in yen, and so forth. So not throwing the towel on gold yet.
So is that really the real yield differential at play there? Right, of like for those that are massively negative real yields, so gold outperforms them versus
or the fact that the dollar has been incredibly strong, and gold is for us, gold is priced in dollars, right? Yeah. So that's so you really, when we think of gold, we think of two trades: long gold, long dollar, right? But if you so the gold part hasn't worked, the dollar part, for Europeans. So no, I think the really the best inflation hedge has been and will probably keep being energy, because that is really the wrecking ball at this point. On days when everything's down, energy has been the only thing that's gone up, because energy is the driver of short-term inflation or short-term disinflation. So I think that argues for an allocation to energy and commodities, not necessarily based on a fundamental view, but on almost a risk management. We came from a world where deflation was the biggest risk. So you held long-term treasuries as a portfolio diversifier. It seems to me that energy and commodities are going to do that in the next decade.
A few things there. So just plain old buy and hold commodities, or some sort of trend approach?
Well, trend works really well, as in a stagflation environment. You look at the 70s. This is really the best. CTAs are really finally, and you look at this year, you had amazing returns in CTAs and systematic trend following strategies. Some funds are up like 50, 70, 80%. So this is the time for these strategies to shine. Of course, you need to be an institutional investor for, most of these funds. So, a way to somewhat replicate that is either, you own the thing, although it's kind of, oil is kind of hard to store at your house, or you own the companies that produce that.
Yeah, I was trying to find this post of like commodity companies aren't commodities, right? Because then you get all the debt and the leverage and the management mistakes and all the issues
but
with that as well.
Correct, but I would think that this, it's always a risk, but I think at this point in the cycle, it's less of a risk than before. I mean, because we come out of like such a brutal bear market. Like typically energy companies or gold miners, they have $1 in their pocket, they spend 10, right? And they acquire and then they buy they buy the other guy who is this, like, it's a very undisciplined, unstructured industry with a lot of capital destruction. And I certainly have seen a lot of that, especially shale of in the past decade. But again, it's been so hard for them. And on top of that, you had the ESG stuff, the drawing capital from them that, if anything, for very rarely, but like you have a much more discipline, much more return to shareholders, which is probably not economically good. I mean, at this point, these guys should just be like keeping the money and just investing, increasing production. But it's not happening because for 15 years, they've been bleeding. The dividend yield is pretty high. I think energy has the highest dividend yield of any S&P 500 sector, which I don't think has ever happened before.
Yeah, and I think that's a big hangover from 2014, right? When energies, and then the banks were just like, no, right? I'm not giving you any more leverage. I'm not giving you any more money. Make do with what you have. So for sure, some better, but that's moving towards this secular theme, right? Of like metals miners, energy companies. Everyone hasn't put the money back into the infrastructure, back into getting the resources out of the ground, and paying for it.
Yeah, and there's a timing aspect to this, right? And it's the time to invest was 5 years ago. So, and then again, that comes down going back to these inflation expectation and still that transitory narrative that it's going to all be better by March 2023. I mean, the problem is that we haven't invested for 15 years. I mean, how in 5 months, especially because we're still not seeing that pickup in capex at this point. I mean, all I hear about is, it's criminal that these guys are making money and we need to tax that money. That's, it's not really still, I don't think there's a lot of appetite for funding kind of conventional energy, long lifeline projects, like, deep sea offshore drilling or stuff like that.
I've long said that's massively deflationary, right? We used to drill down, get some oil. Now you can drill down, drill sideways 500 feet, get to these pockets. Like the technology growth there has been perhaps overshadowing the lack of building new infrastructure.
Indeed. Yeah.
Yeah.
Right.
Well, two things there. So one, okay, if energy's so high right now, is to that timing aspect, is it too late? You're saying, no, this could go on for another 5 years, 10 years.
Yeah, I would think so. I mean, you look at, energy as a share of the S&P 500. I mean, it's still probably less than Apple at this point, or at least it was a month ago. Probably around, 4 or 5%. I think the last time we were there, was probably in 2000 when, oil prices were a fraction of what they are today, and energy profits are a fraction of what they were today. So again, I think it's a slow moving cycle, and sure, by the way, I like this expression, the easy money has been made. Yeah. Is there any easy money? I mean, it's just one of those things.
Right. That was the definition of not easy money, right? If you were invested in ExxonMobil, like people were throwing coal at you. Coal's probably a bad example. People were throwing rotten fruit at you, right? You had a political problem, you had a philosophical problem, and you had a performance problem. They were just in the dumps for years there.
Yeah.
So I totally agree. Not easy money. So you mentioned cycles. Do you think what's your thought on commodities overall? Are we in a commodity super cycle? What does that word even mean?
Yeah, I'm not a commodities analyst, so I think you'd have to be a little more granular depending on, which commodities and so forth. Now, in general, what I'm convinced of is that we are in inflationary era, and in inflationary era, commodities are valuable. In general, I would think that, it's a bad idea to own commodities because, commodities do not pay dividend, they do not pay coupon, and generally humans are smart. When you long commodities, you're smart, you're short human intelligence, which is a pretty bad idea. We'll always figure out, new ways to produce more with less.
Dwarf wheat.
Pardon me?
Dwarf wheat is they couldn't figure the wheat got so heavy it would fall and kill itself. So they genetically modified it to like have 10 times the yield on the same stock.
Yeah, exactly. That's a great example. So, but I think there is there are an exception to this kind of rule of thumb is when you have what we have, a period of structural underinvestment for, many years. And yeah, you get a squeeze. Like, if you look at the oil market, it's not balanced. I mean, you remove Russia, there's just not enough oil for the demand. I mean, all you have to destroy a tremendous amount of demand to get back to balance. And you can do probably the same analysis for a lot of commodities. So there's that scarcity return, which is usually means it can spike up because everybody needs it and you can't find it. That's one reason to own it. And then the other reason is the diversification aspect, right? In a deflation environment, your stocks and bonds have a negative correlation, right? So you can hedge one with the other. That goes away during inflation. And I would argue that commodities claim that mantle. So if you think in terms of modern portfolio theory, your efficient frontier, which had probably zero allocation to commodities at any time in the past 20 years, now you can improve your risk-adjusted return, even though I would argue commodities are a negative expected return asset because they cost you to carry, right? But you can add an asset with a negative expected return and improve your risk-adjusted return because it's so diversifying. So I think, and that would also argue for a greater allocation to the sector from institutional investors, central banks, even retail investors, ETFs, and so forth, which would, kind of get that talk of super cycle, whether it means something or not.
And I'll bring in Greenflation here. So, right, you could argue even with Russia in the picture, even if their energy's there, we're going to need so much energy to pivot to this new green economy over the next 20 years that we're going to use every single bit of fossil fuels to get there, right? Like the amount of metal that needs to be mined, the amount of equipment that needs to be built, the amount of the factories that need to be built to do that is going to use up all that traditional energy sources. What are your thoughts there? I don't know if there's a question.
I agree, and I think that's been a mistake, right? I mean, because yes, if you, and I'm not anti-ESG or whatever. I mean, I've been critical on it, but I theoretically agree with the goals. I mean, obviously, we want to move to like renewable sources. You don't want to like dig holes and pollute the atmosphere to do that. But the right way to do that is to finance the transition. You're going to actually need more conventional energy, and that was a mistake that. I mean, let's talk about Germany, Anna Gewinde. I mean, that was pathetic. I mean, fine, you want to do this, but don't close your nuclear plants at the same time. I mean, or you end up depending solely on Russian gas and giving an insane amount of leverage to a bad actor. And that's the part that politicians really missed. They thought they would just, go from, point A to point C and skip point B altogether. And that's what lies in horror today.
And being a European, France has still a lot of nuclear, right?
Yeah, but we messed up there quite a bit. So it's very unfortunate. So this has been a long-standing French policy since really even before de Gaulle. Basically realized during the Arab the oil embargo that we have no oil and we're dependent on foreigners. So we had to develop our own internal sources. Well, there's no oil in the ground, but we could procure cheap uranium from Sahara. And so we built a very strong nuclear industry in the 70s, 80s. At one point, EDF, Electricité de France, was the largest utilities in the world. About 85% of electricity in France was generated by nuclear, and it was significantly cheaper than the rest of Europe. However, we haven't maintained this very well. So now we get into this crisis where I can't remember the exact number, but I think at least 10 nuclear reactors are shut down. So at the time when we need the most, we don't really have it. Now we're still in a much better position than, say, Germany, which cut it all together and ended up buying nuclear power from France or coal fired from Poland. We kept some of it, but again with the problem of nuclear is a very slow investment cycle, right? I mean, it's like especially the second generation EPRs, it takes 10 years to build. So kind of paying the price of past mistakes here.
But and it's just curious to me if that differs from America to Europe, but doesn't seem like it if Germany shut them down. Like nuclear's gotten lumped in with traditional energy sources, right? It's gotten lumped in with fossil fuels when it's 180.
I think that was a big deal at the the COP, what's the big climate thing, the Glasgow conference.
Yeah.
The French are really lobbying to include nuclear into the definition of renewable. And then, if you take the climate change view, nuclear comes with other risks, but if your goal really, if you believe that, life on Earth will end if the temperature rises by more than 2 degrees Celsius, nuclear is an obvious answer to this problem.
I think it's people's emotional, right? You're more scared of dying in a fiery flash when the nuclear plant reactor breaks than dying slowly over 40 years.
Yeah, correct.
So switching gears a little bit, corporate debt. I had Chris Cole was on the pod beginning of the year saying this is the next big shoe to drop. You posted some interesting data recently. What are you seeing there in terms of the issues in the corporate debt world and where rates are at?
Well, I think it all comes down to bankruptcy suppression, right? Basically, you look at a chart of bankruptcies in the past, 10 years just goes straight down. There's almost no bankruptcy anymore. What happened? How is it possible that for, since the Romans, debtor's prison, companies would fail. Like, why is nobody failing anymore? What does that mean? Well, that means that, does that mean that everybody's smarter and making profits? Of course not.
They're all using QuickBooks better or something like that.
No, it just means that companies that would have otherwise gone under have been able to survive because they've been able to borrow money at cheap rates because there was so much liquidity. So I was looking at the Russell 2000 index, so US small caps. I was looking for companies where operating cash flow, so the most generous metric you can think of, is not enough to cover just the interest expense. I'm not even talking about the tax or the depreciation or whatever, just like, can you just pay your interest bill? And then I also looked for companies, in addition to that, who had less than 12 months of interest expense cash on hand. So that if the market is shut down for them, after a year, they're gone. That's more than 20% of the Russell 2000. And I ran the number as of Q1, so that the trailing 12-month interest expense is based on a junk bond yield of about 4.5%. It's closer to 9. Wow. So that 20% is probably closer to 40%.
And you're saying this isn't a projection. This is taking their actual cash on the book and actual rates, even a different rate than what is today.
Yeah, so there might be a lag here again, because if you're smart, the duration of your liability is not a year, right? So they're not going to start paying 8.5% liabilities right away because they still have the old debt, right? So I think for junk bond index, maybe duration is around 5-6 years. So you only need to roll over 20% of your debt every year. So it's going to take 5 years to pass the entire yield shock, but it will come. I think I think Chris Cole's right. I mean, the obvious big short at the beginning was the kind of speculative profitless tech with ridiculous valuation. Some of them no sales, right? So it's horrible bubbly stuff like .com style stuff. Yeah, that was the story that started. Carvana. February 2021. It's been getting hammered for 2 years now. Most of these names are down by 90%. I think the next shoe to drop is going to be let's call that the zombie companies, right? Companies that they have no economic purpose but survive only because of the availability of cheap credit that's being pulled away.
But so if a lot of those have already been marked down so much inside the Russell, inside the NASDAQ, does that have a lasting effect for market participants at the index level?
That's a good point. Well, I mean, it's if you look in terms of market value, I thought I call that the toxic blob. It's like that. And actually, I think there are two of them. There's one now, and then there's going to be the zombies. The toxic blob is the basically COVID darlings, the stupid companies, trading for like 100 times sale with whatever. So these guys are getting. You're right. They're getting written down very, very fast. Now, the problem is more, you also have new entrants in that blob. So you have these two forces. And last time I checked, actually, the size of the blob was increasing because you have more and more companies, unfortunately, who meet this definition of having, very, very low or negative earnings, And the valuation is not improving, right? I mean, if you think about the companies that had no sale, like what's the multiple on this? Like, I mean, it dropped by 80%. It still has an infinity multiple.
Yeah, exactly.
So that's kind of the problem with real bubbles, in the sense that where you're not really financing an asset that produces anything, is you could write them down, but it's not getting cheaper.
But it's almost like the toxic blob isn't all that toxic. Like it hasn't infected these other better companies. Right. That's the surprise to me of this, has been this orderly sell-off, everyone's calling it. It's just stair step down. So
correct.
Yeah. Why do you think that is?
I think because the economy is doing really well, better than people give it credit for. I think people are, like worrying about recession. Like the reality is the economy is, is booming, has been, I mean, slowing down, but it was growing so fast that, every company that was not in that toxic blob, costs are rising and whatever, but the top line is growing so fast, has been growing so fast that, things have been okay. Like you look at index level earnings, we see that positive earnings growth last quarter. We had, really strong earnings growth in the past 2 years. So I think it will come. It's probably coming, I think, for Q3, Q4 would be my guess, when we have this high earnings expectation, when we'll finally feel the effect of the slowdown. And I'm not calling for a recession, I'm just saying slowdown. And then, the contagion, maybe it happens through the credit markets. Maybe it happens through some very large investor blowing up. And, who knows? Another way it could happen in tech is, I feel that a lot of that spending on stupid unicorns and companies, business model ended up, buying AdWords on Google, placing ads on Facebook, renting server space on AWS. So I think somewhere I read, I think it's a Chamath quote. So it's, I don't know if I should go with it.
Be careful with it. Yeah.
I think Chamath said that 50% of every dollar raised in VC funding ended up in the FANG. I mean, I don't know how it came up with a number or not, but
it makes sense. Everything you just said.
Yes.
Ad spending, the server spend. Right. And now where do they refill that money? I've always wanted to do a blog post on that, of like, when you're on some of these websites and you see this complete junk at the bottom of the page of like, right, of just like, see what these child actors used to look like, and this, right, all that junk. Like, is that really what we built? That's the internet. That's productivity
enhancing right there.
Yeah. And invariably I'll always click on it like once a month, like, oh, that sounds interesting. So maybe they're the smarter ones. Lastly here, I want to do a little world tour with you on some of the areas you've brought to light and get your quick thoughts. We mentioned Japan, so we'll go back there, but more specifically, their JGB peg, their rate peg, what's that doing to the yen, and what the end game there looks like. I think some stuff yesterday was that starting to break.
Well, I mean, there are two end games. I mean, either they destroy the Japanese economy, which is what's happening now, because, you are a large industrial exporter with very thin margin in a highly competitive market, and your currency collapses by like 30% every month, and your PPI is running at 50%, and you have no inflation, so no ability to pass it through. You get destroyed, and I think that's what's happening now. Or, which I think is the more likely outcome, given the historical tie between the LDP and the Japanese elite and the manufacturing export business sector, there is a moment like, okay, guys, we keep doing this 6 more months of this, we're no longer going to be an industrialized nation. So we got to stop that insanity. And then we get the mother of all short squeezes. And we see for me, the template would be, I think it was 2015, the Swiss central bank had pegged the euro. And then, of course, the Swiss franc always wants to appreciate, right? Because it's a better economy, it's better run, money flows through the banking sector. And then the Swiss franc, the SNB was just trying to prevent it. And then when they're like, okay, we can't do this anymore, just like shot up by 20% in one morning. I think we'll see that in Japan. Like I think they'll just fold the towel, give up yield curve control, and then you'll just see that thing of the yen just like pop up in the mother of all short squeezes.
So that, I think we did it. Research that I think it was 20 years of range was in that one daily bar on the Swiss that day.
Yeah. I think it was a 76 standard deviation event.
And there's no, right, it's a free trading thing around the world. So there's no like limits or circuit breakers or whatnot, right? It just goes. It just trades. And so that would affect the dollar in a big way.
I think so. Yeah. I mean,
but so it's weird that everyone's putting on, which everyone I know is guilty of, right? All the trend followers are short the yen in a big way. But you'd think you'd start to see little people starting to place bets on the other side of that.
Yeah. The thing is, what worries me is that it's going to be an event, right? It's going to be one night. It's going to be over. So it's almost an impossible event to time, right? So, I mean, you can, if you're on the wrong side of it, just getting hammered, bleeding, and you have no idea when this bleeding is going to stop. So to me, it's going to be a low of maximum pain. It's a very hard way. It's very hard to profit from.
And where do the JGBs go from there? So they're pegged now. So you're saying they'd come out and say, these are no longer pegged. We're going to let them, their new rate is 3% or something.
I have no idea because it's not a market.
Yeah.
I mean, there are days
when their own
JGB changes hands. So it's at this point just an accounting game between the BOJ and the Ministry of Finance. So if you want to restore a market when none existed, I had no idea what the price is that could clear that.
So does that put the death stake in MMT if this BOJ experiment turns out they throw in the towel?
Well, I'd be okay. I have some sympathy for MMT. I've followed it. I've been a believer for a long time. I would argue that everything that's happening is consistent with MMT. I mean, what MMT people told you is, eventually the only real constraint on the ability to monetize deficit is inflation. That is, this is playbook, textbook MMT. We are now that's the part where MMT is weak, is, because it assumes that, if and when inflation does pick up, then, smart politicians are going to do the right thing and they're going to tax back that's the part that never happens because it's so contrary to our instinct. Even in Europe, you see it. It shocks me, by the way, on inflation. I still feel we have this view that it cannot happen here, right? We're not Brazilians here. I mean, we're better than that. Like, look at what people are doing. Government of Netherlands just said, "Oh, gas prices are high. I'm going to send everybody €1,000 check." In the US, we have like price gouging bill. Oh no, these guys are making profits. Let's tax them. We are reacting in the exact same way that Hugo Chavez or your average Peronist, Argentine politician would react, and still we think we're so much better than that.
I don't get that. Of like, here's a gas credit to buy more gas for when we have a gas price problem. All right, moving on. Well, we'll move to this one. Speaking of gas, so Norwegian krona versus the Swiss.
Well, I like them both. I mean, the virtue of the Norwegian krona is the energy play, right? And that's but I mean, in terms of countries, they're very similar, right? So they're both, very small, very wealthy, very well-run countries, which were smart enough not to get into the European Union. And as a result, I think have the ability to, when the train wreck eventually happens, or maybe not a full train wreck, but let's say I wouldn't want Lagarde's job right now. They have more flexibility. They have these huge reserves, right? I mean, I know for Switzerland, it's the equivalent of 120,000 euros per capita in FX reserves. So they can pretty much set the price of their currency the same way. For Norwegian, the government pension fund, the oil fund, is the largest investor in the world. I think they own about 2% of the world stock market cap. So, and my view is that, we are in a new era where, 10 years ago, it was competitive devaluation, right? The central bank who won was the one who could devalue the currency the fastest to still grow from their neighbor. Now it's the exact opposite, right? The biggest problem is import inflation. You want to keep your PPI low so you can keep your manufacturing sector competitive, so you need a strong currency. Who has the best shot at having a strong currency? I would say it's Switzerland and Norway, because of the huge reserves, because of the fact they've been suppressing the currencies for a long time, and because of the fact they're so wealthy and generally well run. So these are the kind of places where people want to put their money anyway.
And so your theme there is be long both. And
I would say
energy comes down, you'll
correct
do better on the other side.
Correct, and I would hold them against the euro as the clearest bet. I mean, the dollar is kind of a hard one. I mean, I would be tempted to short the dollar, but I don't know. Brent Johnson taught me better. It's kind of it's very frustrating for a foreigner that there are no consequences in the US. You can be as stupid as you want, and still, when you have a big market event, your currency rallies so much. So that's why the best, take a fundamentally flawed currency like the euro as the other leg of that trade.
So I didn't have that on my list, but since you mentioned it, so the euro experiment will be short-lived, will end one day. What do you think?
Well, I mean, everything ends one day. I mean, including the dollar. I mean, I would,
which ends first, the euro or the dollar?
Probably the euro, but I think at the end of the day, I think it's about what you care about most, and the level of, I think people underestimate the level of attachment to the euro for the European elites and the willingness to make insane sacrifices. It's like almost a sacred cow, right? I mean, and I think that's why people underestimate in 2011, 2012, when it's that crisis. Like, we are going to put, half of Europe in a depression in order to keep our stupid little currency, because it's too costly for us to admit that we're wrong in the first place. And I think that logic is still there. Now they don't have the tools to do it. I think Lagarde is kind of working on it. I mean, the problem now is they need to raise rates. As they raise rates, so do spreads. If spreads keep getting higher, it's a problem. Now, I think people overestimate how quickly that's going to happen, because Italy is the maturity of Italian debt is about 8 to 9 years, so it's going to take quite some time for Italy to start paying. They have the reimbursement from the PPP, so they have a bunch of stuff they can do. And I sense, and that's something that I've seen, covering European markets for 15 years. Americans are just so ready to jump on the euro because they think, obviously, it's stupid. Okay, we all know that, but stupid things can last if there is the willingness to defend them. And I think that's the part that they underestimate.
Hey, Bitcoin's still at 20,000. So point in case. But if you had to fix it, what would you do? You get rid of Italy? You get rid of Greece? You get rid of who?
How don't you get rid of it? I mean, you do full fiscal union. I mean, you just do what you guys did after the Revolutionary War, and you have transfers. You don't, in the U.S. You don't measure whether Alabama is subsidizing New York, or I don't know which one it is. Probably.
Well, we do. You see more and more of that, but it's not. It's not
but it's consolidated. Like you don't keep the regional feds. You don't keep a separate balance sheet and tell you, you owe me.
So you mentioned the Swiss, like in the Swiss. So you've been tweeting around the Swiss milkshake. So that's a Brent Johnson steal off his dollar milkshake.
Yes.
I'm going to give you credit for it, though. I hadn't heard it before. It sounds better, right? It sounds more tasty. Swiss milkshake than a dollar milkshake.
They make really good milk and really good chocolate in Switzerland, which, none of these things are made in the US. So,
so what's the theory there on the Swiss milkshake?
Well, same argument, really, that, we've entered this new era where the game is which country can defend its currency the best. And you look at the world, to me, it's clearly Switzerland. I mean, you have I think this year they're going to have a budget surplus, Okay. Inflation in Switzerland, I think, is around, well, maybe it picked up a little bit, but I don't think it's above 4%. Massive current account surplus. So if a country, and then these reserves, right? These insane reserves, like, I mean, basically, after a way, the entire world has gone QE. And for the US, Japan, and Europe, we just bought our own bonds, right? So it neither created a liability or an asset, right? We're just buying a claim on ourselves. In Switzerland, they did QE, but they bought other people's stuff. So the SNB, for example, is probably one of the largest holder in the stock of Apple and Microsoft. They've just been buying, these US or the German bond market. So they have, I think, more than $1 trillion in currency reserves, which can be mobilized in order to defend the Swiss franc, which I think they will do. I mean, they had to import the policy of the ECB, which I think they hated, because of how integrated they are with the European Union. If the euro does something stupid like negative rates, they have to copy it. And the Swiss is generally smarter, And I think they hated it, but they had to do it. But because otherwise you would have massive deflation, it would have become like Japan. Now inflation is back above 2%. They can let go of it, end the currency repression, let the Swiss franc appreciate. Yeah, again, I would play that versus the euro, because I think, Switzerland does not have to deal with Italy or Greece or Spain. So if you need to move fast, the SNB is probably the best European central bank to do that.
And what about their playing along with the US on the sanctions with Russia? They seems like they lost a little neutrality in that episode. Which
I think that's one of the reasons why my trade hasn't worked. It's really I started that pounding the table in January on the long the Swiss franc, and then a month later you got Russia invade Ukraine. You generally they don't want to ask a Swiss banker where the money's coming from.
Yeah.
So I think there was quite a bit of Russian money in Swiss banks, and Switzerland is not in a position. I mean, they have to go along, right? So the traditional role of the Swiss banking sector, that's a place where it's safe to keep dirty money, where without many questions, that's probably a little bit under threat, and that's probably way down on the currency and also on the performance of some of the big Swiss banks.
And then also they own all that Apple stock that's down 20%. So at some point, all those earnings are like, right? Some people are calling them the world's largest hedge fund, right? What if they went short some stuff? And then China and Brazil, how have your thoughts evolved on each of those over the years?
Well, I think for China, I think the mistake people make is kind of underestimate the demographic squeeze that's coming out of China and what it means. I think that the notion that China will keep being the manufacturer of the world and will keep subsidizing the West, I think this has changed. I mean, China now is kind of reminds me maybe of, I don't know, Germany in the 70s or something like that, where their interests are going to change dramatically, and they will try, that instead of being a surplus country, they're soon going to be a deficit country. They will start to need a stronger currency. They will need currency integration. So, I mean, I guess the long story short, the trade implication from the slowdown of China, I think, is to be long Chinese government bonds. The same way it was a fantastic trade to be long German bonds in the 70s, or Japanese government bonds after the bubble burst, because you'll get two sorts of returns: one, much lower rates than the rest of the world because their population is shrinking, and a stronger currency. On Brazil, to me, I've had this call for 8 months. It was very painful at the beginning, and then it took off. I think it's a very undervalued commodity exporter that does not share a border with Russia, where you have 10% plus overnight rate. And that's true of most of Latin America. I mean, this is a very rare moment where Latin American central bankers have been smarter than the rest. Like, they saw the inflation come, or maybe didn't have a choice. But by the time the Fed started hiking, these guys already were up at 10%. So if your worry is, you don't want to fight the Fed, well, go to Brazil, go to Chile, go to Colombia, go to Peru. These guys have done probably 95% of the hiking cycle already.
I've talked with some Brazilian hedge fund guys who are like, well, our hurdle is like 18%, right? They have to get over because they can get 10% in the treasury. So tough game for a hedge fund manager down there, but in theory, the opportunities are bigger. You said you're not a Fed guy, but I had a question for you because the ECB and the Fed. So if we're starting a fictitious country or global economy, and you have to pick one to pick your fighter in Twitter meme style, pick your fighter to run our new fictitious country's banking system, ECB or Fed?
Well, if we talk about chairman, it's an easy one. I mean, I take anybody over Lagarde.
Okay, and she's French, right?
She is French, yes, but
is that way?
She's not an economist. She's not a banker. She's
they're all lawyers.
An attorney. That's right. Yeah, but I primarily, she's a synchronized swimmer, and that's something that the one area where I really respect Christine Lagarde. She made the French national team in synchronized swimming in
Really?
her late, before she was 20. And I think that that's her main skill. And you can really see it in the way she conducts herself at the ECB is, I mean, she just watches what Powell does and just repeats it with a 6-month lag perfectly. But that's probably not what the ECB needs. I thought, I mean, in general, I would say the ECB has the weakest hand among all central banks, right? Because of the flaws of the union. So you really need an extraordinary central banker to, it's like, you playing poker and you have like a pair of 7, hand. Right? And that's all you got. And you need a master bluffer. And we had that with Draghi. And I think we lost that.
And why can't they get her out of there? What do the mechanics look like for that?
Well, so you have all the political stuff, right? So it's like, okay, Northern Europeans already, I think they made an exception to this, right? Because after Draghi, it should have been a German, but they wouldn't get Weidmann, the Bundesbank guy, because he was too hawkish back then. And then Lagarde kind of came in as a compromise. She's French is neither Southern nor, and she's a woman, and she's, she's very eloquent. Like she was somewhat, there was basically this deal between Macron and Merkel where the Germans would get the Ursula von der Leyen, the European Commission, and then you have to give something to the French. So they agreed to give her the ECB. So again, it's all this horse trading. So you cannot just undo that very easily. And nor would I think that anyone in her shoes could do anything better at this point. I mean, it's just a horrible job. And she's going to have to basically swallow her sword or fall into whatever the expression is.
I like swallow her sword. She'll have to get past her Hermes scarf to swallow her sword, right? Was that your little imagery, right? Of like she's talking about the poor with her Hermes scarf on?
Yeah. There is a strong Marie Antoinette vibe here. Let them eat cake when every ECB conference. Because it always ends up the same. And I'm not. Listen, I don't know if I'd do any better if I wear their shoes, okay? Yeah. But it always end up like, oh, we're not worried about inflation because wages are not going up. I mean, what they're really telling you is that their plan is for you to starve because, they failed to address inflation at the proper time. And now, you look at Europe, we get our gas from Russia. We don't have a good way to deal with it. We don't have an alternative. We can't do anything. So the best hope for Europe at this point is that wages don't go up and people, lose like 20% of their purchasing power and don't protest about it because, it's in order to fight Putin or to fight climate change. Strong Marie Antoinette vibe here.
And like, who would want that job in the first place? Kind of in the Fed too. It's like you should almost be disqualified if you want to serve in that role. Last bit here, give me your hottest take. Either something nobody's talking about, something that you think one way and everyone else thinks the other way. Got anything for us? Sorry, I didn't prep you for this one.
You did not prep me for this. I don't know if it's a hot take or not. I suspect you share that view, but this is not a market rout. This is a very orderly sell-off. We haven't seen the kind of stuff that you would see where you get margin calls everywhere, hedge funds blowing up, massive spike in volatility. Like I think that after last week there was this desire to say, oh, this was the big dramatic event, this was the bottom, pretty much every stock on the NYSE was down. I don't think that is it. I think that comes in the fall. I think we have another 20% to go in the fall, and this is when the real pain will be felt. I don't think for now it's not real pain.
Another 20% from down 20, so eventually we'll be 40% off the highs.
Yeah,
nice. What does that put the NASDAQ at? 80 or something? So it'd be basically an 08 redux of those types of levels.
Yeah, with maybe more on the NASDAQ. I mean, NASDAQ was down 80% in from between 2000 and 2003. Yeah. So, you look at, where valuations have been. And again, at this time, keep in mind, we didn't have the problem of inflation.
Yeah.
We had a Fed put back then. So here we have, I would argue we had a similar, if not worse, overvaluation of certainly the NASDAQ. And on top of that, we have to face a beast that we haven't seen in 40 years, which is secular inflation.
And you think it happens more violently, that next leg down? I think me personally, like no one ever seen a second leg down really, right? It's been either the sharp spike, right? We never had this down sideways for 12 months and then another 20% down since way back when, like Great Depression level. So yeah, that's kind of where my head's out of, like, nobody's prepared for that second leg down.
Yeah.
And even worse, they're probably saying there's not going to be a second leg down, and they're piling in at these levels. And so how do you position for that versus just going short equities or whatnot? Milkshake.
Yeah, Swiss milkshake, cash. I mean, it's stupid because I'm the inflation guy, and I'm like, I have a ridiculous amount, seemingly far too large personal allocation to cash. But I mean, I'd rather lose 8% to inflation than 50% to a bear market. Cash is gaining value when it's measured in asset terms. We already discussed, I mean, precious metals, I mean, as long as you have like reasonable expectation of what they can do. Some energy, I still think, Latin America comes in stronger from this than, at least on a relative basis. Like, it's at this point, it's not even an equity list anymore. That's not even Latin America is probably, like, as a continent, is, less than Apple. So, you're not taking a big risk there. Now you want to be fun and have some fun and have a story to tell your grandkids. You buy the Japanese yen and hope that event happens and you look smarter than everybody else.
That's the one I'm doing. I'm taking that away from our chat. Maybe there's a triple levered yen ETF we can look at. But you would have been
it's probably already bankrupt if there's a triple long yen ETF.
Like, if that was triple levered long, you would be down 99.9% so far. All right, any last thoughts for everyone there? Tell them where they can get you on Twitter and all that good stuff.
Okay. So I'm at Vincent Deluard, VINCENT DELUARD. I am active on Twitter, not as active as some of my friends, but I enjoy it. I've met very many smart people, including you. So you can follow me there. There is if you look at my pin tweet, there is a link to where you can register for a free trial of my work. If you are a client of StoneX, we are, big FCM. We have, big securities business. You should talk to your whoever covers the account and see if you can get added to my list.
Talk to your friendly RCM broker. We'll get you added.
Exactly. And if not, we also the research can be had as a subscription only product. It's priced very reasonably. We grant free trials to everybody who asks for them. Otherwise, Twitter is where it's at. I hope Elon Musk keeps it that way.
Yeah. Who are most of your customers on the research? It's mainly all the StoneX customers, or you get some paid subscribers?
No, we do. So initially it started with the StoneX customers. We have a lot of business in Latin America, so I have a big following among Brazilian hedge funds, pension funds across Latin America, and that's also helped me frame the kind of inflationary.
Well, now I'm going to say, like, I don't know if I trust your Latin America calls now. You're helping those clients.
But it's helped me kind of. These are people who understand what inflation is, and understand also the value of real assets. So there is that, and then I've been. We've got a lot of interest. I mean, the inflation call was very early, but turned out to be very right. So we, historically have a big following in Europe. So private banks in Switzerland, places like that, and we're looking to grow this business. So hopefully this will help.
That question popped in my head when you're talking to these Latin American guys. So do your research views come from like talking to the practitioners, talking to the people trading these markets, or you're sitting in your ivory tower coming up with the thoughts?
A bit of both.
It doesn't look ivory. It looks wooded. You have these nice wood beams there. Your wooded tower.
No, but a bit of both. And I mean, also one thing that's helped, I think, it's things like what you're doing, podcasts, Twitter. I mean, you really have, I feel, I've seen in my career, like so many more resources if you want to educate yourself about global macro, about investing, and access to really smart people. And I must say, I've been impressed. And so, people have taken the time to talk to me and to, if I have a question about a very technical aspect, I mean, I can ask someone who's written, a 20 tweet thread on this on Twitter. And more often than not, these people will take the time and they will share Excel spreadsheets. And so it's fantastic. I mean, when I started my career, that did not exist. And now I think, this is actually truly productivity enhancing. So
someone had a thing once. He's like, it's like George Soros or Jesse Livermore or something, like had a hotline phone on their desk and you could just call them at any time and they'd answer. Like there's some super smart hedge fund guys managing billions of dollars that will answer DMs and tweet intelligent stuff out. Yeah, it's an amazing time to be sure. And my last piece was going to ask you, what were you at StoneX before they were StoneX, when it was FC Stone?
Yeah, I started when it was INTL FC Stone. I actually started after Brexit. Brexit is the I was ahead of the Europe product. Started the Europe product for Ned Davis Research before that, and I think how I got to StoneX is when the Brexit vote happened. Where Ned Davis was owned by a British company who was very anti-Brexit, and I didn't have very strong feeling either way about it. I just thought it's democracy, And they asked me to write a piece of propaganda, predicting that frogs would fall from the sky and harvest would die because of that Brexit vote. I'm like, hey, how do you want me to do this? And then I had been in talk with INTL for a while. It's great company, great team. They wanted to build in their own global macro product, and they promised me that they would never ask me to write something stupid to please the ideological preferences of the CEO. So I'm glad I did.
I was more going to ask you what you thought of the name, the StoneX.
StoneX is good, man. I mean,
FC Stone was weird.
INTL FC Stone is where we started. Okay, so it's all about your benchmark here.
Right, I'm showing my age because I just knew it as FC Stone. Then it was INTL FC Stone, and now StoneX. But all the same group. Awesome, Vincent. Thanks so much. Have a great day. We'll talk to you soon.
Thank you so much.
Appreciate you coming on. Yeah,
pleasure.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.